Hey everyone, welcome to The Explainer. I am beyond excited for today's topic. If you've ever looked at a crypto or stock market chart and just felt completely overwhelmed by all those jagged lines, you are definitely in the right place. Today, we're putting together the absolute ultimate beginner's study guide to decoding market charts. So grab a notepad, get comfortable, and let's unlock this visual language together.
Because when you first pull up a trading chart, let's be totally honest here. It usually looks like pure, random chaos. A lot of beginners take one look at those jagged red and green lines and think, wait, is this just financial astrology? Is technical analysis literally no different than reading tea leaves? It's a super common feeling. It kind of looks like trying to find patterns in total static. But what if I told you this specific method of charting isn't just some modern crypto fad?
Believe it or not, the technique we're looking at today has actually been around for over 300 years. It was invented back in the early 1700s by a Japanese rice merchant named Honma Munehisa. He was the very first person to document and trade these price patterns, and he basically invented the candlestick chart right then and there. And his results? Well, it's widely believed he made the modern equivalent of $10 billion in profit. $10 billion! Just by trading these patterns. So yeah, clearly there's a little more to this than just tea leaves.
Okay, let's dive right into this. Here's our syllabus for today. First, from tea leaves to trading. Second, anatomy, bodies and wicks. Third, the fear and greed cycle. Fourth, neutral and reversal patterns. Fifth, continuation patterns explained. And finally, real charts and hidden risks.
All right, Section 1, from tea leaves to trading.
Moving right along to Section 2, anatomy, bodies and wicks.
Now, if you're a beginner, this right here is the absolute foundation of the candlestick alphabet. You really have to understand this part perfectly before we can start reading the words and sentences of the market. Every single candlestick consists of two main parts. The first is the body. The body is that thick, chunky part of the candlestick right in the center. It simply tells you where the price opened or started and where it closed or ended during a specific time period. So if you're looking at an hourly chart, one thick body represents the starting and ending price for that single hour.
The second part of the anatomy is the wick. These are those thin lines extending out from the top, the bottom, or sometimes both sides of that thick body. The wicks tell you the absolute extremes of the price action. They show you the absolute highest peak and the absolute lowest valley the price actually hit during that exact same time frame. Basically, they capture the full story of what happened before the closing bell even rang.
Now, let's talk about the colors because they're formed incredibly logically. A green candle means prices went up during that period, so logically, the starting price is at the bottom of the body and it closed higher up at the top of the body. A red candle means prices went down, so it's the exact opposite. The starting price is at the top of the chunky body and it fell to close at the bottom. Bottom to top for green, top to bottom for red. Super straightforward.
Okay, Section 3, the fear and greed cycle. Now that we know the alphabet, we need to understand why these shapes actually form. And the secret here is that these shapes aren't random at all. They're direct, visual reflections of the collective human psychology of everyone trading that asset. Now, what's really interesting about this slide is how perfectly candlesticks map to human emotion. Holmes' big, groundbreaking discovery was that emotions follow these predictable loops. Step 1, price goes up, people get greedy, and they buy heavily. Step 2, buyers max out. They literally can't buy anymore, so someone takes profit and starts selling. Step 3, the price falls, triggering intense fear, so people panic sell. And finally, Step 4, sellers exhaust themselves and the cycle readies to repeat. What candlestick patterns fundamentally do is give you a sense of exactly where the market is inside this emotional cycle. Next up, Section 4, neutral and reversal patterns. So we can actually categorize the shapes we see into specific buckets, starting with neutral patterns. On screen, we have three types of a pattern called a doji. Doji is actually a Japanese word that roughly translates to the same thing. Just look at these. They're almost all thin wicks with barely any chunky body at all. The gravestone doji has the tiny body at the very bottom, meaning price pumped massively but came right back down to where it started. The dragonfly doji has the body at the top, meaning it dumped massively but buyers pushed it all the way back up. And the regular doji has the body right smack in the middle. All three of these show that despite massive intra-hour pumps or dumps, the price ended right back where it started. Total indecision by the traders.
Next up, we have bearish reversals. These signal that a greedy, bullish trend is dying and fear is starting to take over. Take the shooting star, for example. It's a red candle with a long upper wick showing sudden profit taking. Then there's the bearish engulfing, where a green candle gets completely swallowed up by a massive red candle. That's pure, sudden fear. Finally, the advance block. This is 3 green candles in a row, but their bodies are getting smaller and smaller. This visually shows bullish momentum completely running out of steam. And just a quick side note, in highly emotional markets like crypto, engulfing patterns are incredibly common.
Now, mirroring those, we have our bullish reversals. These signal that a painful downtrend is finally over and sudden greed is taking over. The inverted hammer looks exactly like the shooting star we just talked about, but it's green and happens at the bottom of a downtrend, showing really aggressive buying at low levels. The bullish engulfing is a sudden massive green candle swallowing a smaller red one, which is just pure sudden greed. And 3 stars in the south is the exact opposite of the advance block. It's 3 red candles getting smaller and smaller, showing the fearful bears have finally completely exhausted themselves.
Let's move on to Section 5, Continuation Patterns Explained.
You know, sometimes the market isn't reversing direction at all. Sometimes it's just taking a very, very violent pause. And this brilliantly illustrates the core concept of a continuation pattern. We really shouldn't think of these as just simple chart shapes. They're a vicious turf war between the bulls, who want the price up, and the bears, who want the price down. In a continuation pattern, one side fights incredibly hard to reverse the trend, but ultimately, they lose the war.
Check out these mat hold patterns. A bullish mat hold starts with a massive green candle, so the bulls are in charge. Then, 3 small red candles form. The bears are fighting back, really trying to drag the price down. But then, boom, a massive final green candle completely blows out the upside. The bulls win the war. The bearish mat hold is the exact inverse. What's absolutely crucial to understand here is that these massive final candles are often caused by leverage trading. When traders bet heavily the wrong way on margin, they get forcibly liquidated. That forces automated buying or selling, which creates these dramatic, giant candles on the chart.
Finally, Section 6, Real Charts and Hidden Risks.
Theory is great, but let's move to action and see how this builds in real market history. Recently, Bitcoin pumped, but then painted an advanced block on the daily chart. Remember, that's 3 green candles getting smaller. Bullish momentum died, and exactly as the pattern suggests, a correction followed. For Ethereum, after hitting a low of around 1.5K, it painted a textbook bullish engulfing on the weekly chart, that massive green candle swallowing the red one. The result? A huge surge to the upside. But hey, it's not all sunshine. Looking at Ethereum priced against Bitcoin, it recently painted a scary bearish advance block, foreshadowing a pretty nasty downward reversal.
So the crucial point is summarized perfectly by trader Dale Pinkert. He says, what is obviously wrong. You can never forget that you are not trading in a vacuum here. There are thousands of other traders, including massive institutions and incredibly wealthy individuals we call whales, and they see the exact same patterns you do. Sometimes they'll intentionally manipulate prices to make a textbook pattern appear, literally just to trap less experienced beginners and steal their money. Pretty crazy, right?
Which brings us to our vital caveats. First off, tail risks. Things like sudden global pandemics, a country suddenly banning crypto, or unexpected money printing, those will completely invalidate any chart pattern instantly. Real-world news beats lines on a screen every single time. Second, in practice, these patterns look incredibly messy. They are almost never perfectly textbook. Third, shorter time frames, like 15-minute charts, are just wildly volatile. Higher time frames, like weekly or monthly charts, are vastly more reliable. And finally, if a chart is confusing and you can't clearly spot a pattern, sitting on the sidelines and doing nothing is very often the smartest trade you can possibly make.
Which leaves us with this final thought. Technical analysis and candlestick reading is an incredible 300-year-old tool that absolutely gives you an edge. But it is not a magic crystal ball. When a sudden tail risk hits the market and shatters your perfect chart pattern, how will your trading strategy survive? It really all comes down to risk management. Study these patterns, look at charts from different vantage points, but above all, practice safely before putting your real money on the line. Thanks for joining me on this explainer. Keep studying, and I will see you next time.